What really happens when a recession hits? And why does it feel like everything slows down at once? Jobs become uncertain, businesses cut back, spending drops, and fear spreads through the economy. But a recession isn't just bad headlines. It follows patterns, causes chain reactions, and eventually leads to recovery. Today, we're breaking down what truly happens during a recession, how it affects everyday people, and what smart moves can help you stay prepared. Today, we will talk about what really happens during a recession. So, before we start, make sure to hit the like button and subscribe to my channel. 1. Economic slowdown begins. A recession begins when economic activity declines significantly across the country for an extended period. Businesses start producing less because demand for goods and services falls. Consumers reduce spending due to uncertainty, job fears, or rising debt. As spending slows, company revenues shrink, leading to cost-cutting measures. Economic growth, usually measured by GDP, turns negative for consecutive quarters. Investor confidence weakens and markets become volatile. Companies delay expansion plans and new investments. Banks may tighten lending standards, making credit harder to access. This slowdown spreads across multiple sectors, including manufacturing, retail, and services. A recession does not happen overnight. It builds gradually as economic pressure increases. Reduced economic momentum affects incomes, savings, and overall financial stability. Governments and central banks closely monitor these warning signs to prevent deeper damage. The initial slowdown sets off a chain reaction that impacts employment, businesses, and financial markets across the entire economy. 2. Rising unemployment. One of the most visible effects of a recession is rising unemployment. As company profits decline, businesses reduce costs by freezing hiring or laying off workers. Small businesses may struggle to survive, leading to closures and further job losses. Higher unemployment reduces household income, which weakens consumer spending even more. This creates a negative cycle where lower spending leads to additional layoffs. Job insecurity also affects those still employed, making them cautious about major purchases or financial commitments. Youth and low-income workers are often hit hardest during recessions. Long-term unemployment can damage skills, confidence, and future earning potential. Government unemployment benefits may increase to support affected families, but these measures may not fully replace lost income. Rising unemployment is a key indicator of recession severity. The longer job losses continue, the more challenging economic recovery becomes, as rebuilding workforce participation takes time and sustained economic improvement. 3. Decline in consumer spending. Consumer spending makes up a large portion of most economies, and during a recession, it declines sharply. People prioritize essential expenses such as food, housing, and utilities while cutting back on travel, entertainment, and luxury purchases. Fear of job loss or reduced income encourages households to save rather than spend. Credit usage may decline as banks tighten lending conditions. Retailers, restaurants, and service industries often suffer first from this reduced demand. Lower spending affects company revenues, profits, and hiring decisions. Businesses may lower prices to attract customers, which can reduce profit margins further. Consumer confidence indexes often drop significantly during recessions, reflecting widespread uncertainty. Even individuals with stable jobs may delay big purchases like homes or vehicles. As spending slows, the economy contracts further. Restoring consumer confidence is critical for recovery, as renewed spending fuels production, investment, and job creation across industries. 4. Business failures and bankruptcies. During a recession, many businesses struggle to survive. Reduced sales and limited access to credit strain cash flow. Companies with high debt levels face difficulty making loan payments. Small and medium-sized enterprises are especially vulnerable because they often have limited financial reserves. Bankruptcies increase as businesses close permanently or restructure operations. Industries dependent on discretionary spending, such as tourism and hospitality, may experience severe losses. Large corporations may downsize operations, sell assets, or merge with competitors to remain stable. Supply chains are disrupted as weaker companies fail, affecting even stronger firms. Financial institutions monitor rising corporate defaults closely. Business failures contribute to unemployment and reduced investment. However, recessions can also eliminate inefficient companies, allowing stronger firms to emerge during recovery. While painful, this restructuring process can lead to long-term economic adjustments that improve productivity and competitiveness once growth resumes. 5. Stock market volatility. Financial markets often react quickly to recession fears. Stock prices decline as investors anticipate lower corporate earnings and slower growth. Market volatility increases with sharp price swings driven by economic news and investor sentiment. Sectors such as technology, consumer discretionary, and financial services may experience significant losses. Defensive sectors like utilities or healthcare may perform relatively better. Investors often shift funds towards safer assets like government bonds or cash. Falling stock prices reduce household wealth, especially for those invested in retirement accounts. This wealth effect can further decrease consumer spending. Market downturns may create long-term buying opportunities for patient investors, but short-term losses can be severe. Central bank announcements and government stimulus measures strongly influence market movements during recessions. Overall, stock market volatility reflects uncertainty about future economic conditions and the speed of potential recovery. 6. Tightening credit conditions. Banks and financial institutions become more cautious during recessions. As economic risks rise, lenders tighten credit standards to reduce potential losses. Businesses and consumers may find it harder to obtain loans or lines of credit. Higher risk premiums increase borrowing costs, even if central banks cut interest rates. Reduced credit availability limits investment and spending, slowing economic activity further. Companies dependent on financing for operations may struggle to survive. Mortgage approvals decline, affecting housing markets. Tighter credit can also discourage entrepreneurship and new business formation. Financial institutions focus on strengthening balance sheets rather than expanding lending. While cautious lending protects banks from excessive losses, it also deepens economic contraction. Restoring credit flow is essential for recovery, as access to capital enables businesses to grow and households to invest in major purchases once confidence returns. 7. Government and central bank response. During a recession, governments and central banks take action to stabilize the economy. Central banks may lower interest rates to encourage borrowing and spending. They might also implement quantitative easing to increase money supply and support financial markets. Governments often introduce fiscal stimulus measures, such as tax cuts, infrastructure spending, or direct financial support to households and businesses. Unemployment benefits and social programs may expand to protect vulnerable populations. These measures aim to boost demand, restore confidence, and prevent deeper economic decline. However, stimulus policies can increase government debt. Policymakers must balance short-term recovery efforts with long-term fiscal responsibility. Effective coordination between monetary and fiscal policy plays a critical role in shortening recession duration and supporting sustainable recovery. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.